Hello and welcome back. So in the next few slides, we're going to talk about product pricing, in particular different methods that you can implement when pricing your products and launching the product to the buyers, pitching the products to the retail buyers. There are several different ways. You probably heard of some of them. If you did not know the terminology, that's totally fine. It is more about you seeing it as an end user, as a customer when you go shop for either groceries, apparel, shoes, whatever. It is very important task that you're going to embark on because it is crucial that you price your product just right in order to sell it successfully and profitably. So let's explore some of these different methods. So you are in a wholesale business. That means that you manufacture or produce something or buy directly from manufacturer, and you're selling it to another business that will actually go ahead and mark up the price and sell it to end user. So the crucial point of being in wholesale business is to build those long-lasting relationship with buyers so they can place more orders, and both of your businesses can grow. So it is highly relational business to be in. One way to attain clients or meet with prospects is either through trade shows, some kind of expos, or even online B2B platforms. Those are all available to you, and you should be able to know about them and participate in some of them so you can grow your business. So in the next few slides, we're going to visit different pricing methods, see what's the best one for you, and maybe you adopt a hybrid. You're implementing a couple of different methods in order to run your business in a profitable manner. So once you know the product that you would like to place and start selling on wholesale basis and pitch to other buyers, you know your cost of goods, cost of sales, you're going to put all that together and you put the desired margins and you're going to sell it as a wholesale product. So a very simple formula. And here it's showcased something that's called keystone pricing. So that is wholesale versus retail. Labor and material is equaling your cost. Cost times 2 is wholesale price, and then wholesale times 2 equals to retail price. We can talk a little bit more about what does it go into that labor on, how, when you're making that particular widget that you're selling product and what do materials cost, the raw goods, the raw materials. When you put it all together, you're going to time it 2 because you want that 50% of the sale of the sell price to be your profit. And then, of course, if you time 2 again, that will bring you to your retail price. So here are the 6 basic methods of wholesale pricing: cost plus pricing, competitive pricing, value-based, price skimming, discount pricing, and keystone. We're going to dive into each one a little deeper so you have a better understanding of which one is the best suited for your own business and your products. So the cost plus pricing, just like it says here, is also known as a markup pricing. It is very common and it's the easiest way to determine the price of a product. So you make the product, add a fixed percentage on top of the cost, and sell it for total. So how does that look like? If you make the product and it costs you $20 to make it, you can put 50% on it. So now the sell price is what? $30, right? You can use any type of formula. It will kind of come to the same results. It will be just the percentage markup. And quite a bit of retailers mark their products just like this, or should I say price the products just like this. Competitive pricing refers to using competitors' pricing data as a benchmark and consciously pricing your products below theirs. So what does that mean? You're going to go out there on the market and check out your competition. You're going to see what they're charging for what type of product, for what type of maybe service that comes with product, product size, weight, features, and you want to make sure that you're comparing apples to apples and see if this is a good price to start with, and since it's competitive pricing, you want to be a little bit under that particular price that your competition is charging. So how could that look like for your product? Let's say you are in producing TVs, you are in electronics business, and your competitor on the market is selling it for $350. You can go ahead and sell it at $329. So it's just a little bit below what they're selling, but you're doing this in hope that the competition, competition's clients, customers will actually come to you because you are at selling your product at much lower price. This is interesting one. Value-based pricing refers to setting a price based on how much the customer believes a product or service is worth. So you have to kind of see what's out there on the market and if you have competition and how strong is your competition. If you have any type of unique selling propositions so that your product or service are completely different from somebody else's, or just really niche and you don't have much competition to begin with, then of course that kind of equals to you being able to charge a higher price. So just think about where does your product fall at any given time and price accordingly. A price skimming strategy, as it says here, refers to when a business charges the highest initial price that the customers will pay, then lowers it over time. I'm pretty sure that everybody's seen this type of pricing, even in the grocery stores, in apparel stores, any type of retail that has high margins in the beginning, meaning higher price, and as the markets gets a little more saturated or there's odds and ends left when it comes to colors or sizes of the product, then or maybe it's just out of fashion and dated, then the retailers start giving you 10% off, 20, 30, 50, 90, and just to move the merchandise and get it out of their way. So that's also a very legitimate pricing strategy. Discount pricing is as it says here, top pricing method for retailers across all sectors. Why would they want to do that? Because they do want more foot traffic. They want quickly sell the inventory because the faster they get it out of their way, the sooner they can get new merchandise and something that's trending and it's fashionable at that moment. So they want always nice, fresh, so that people can come back for more merchandise and cater to, in this case, to more of a price conscious group. This would be maybe your stores such as Costco, Walmart, and any type of big box stores that buy volume and have a very low margin. So they're very deeply discounted, correct? This is the easy one, keystone pricing, and often you'll hear this term when you're negotiating prices with potential buyers. They might just go keystone. So if your sell price, right, that they are going to be buying your merchandise for is, let's say, $10, the keystone for them would be 20. So they're just pretty much doubling. And it's easy rule of thumb, not too, math is not too complicated. You can always verbalize this price in front of them as a suggested retail price. So it might look like this. Your merchandise and all of the labor and parts that goes into putting together a finished product might be about, let's say, hypothetically speaking, $5. You might want to go ahead and sell that product for 10 and the retailer will sell it for 20. Okay, so everybody's enjoying their margins. I hope this was a good explanation of different pricing methods. It is important for you to think about in which pricing method, first of all, you would like to adopt, but most importantly, what does your market determine? What type of merchandise do you sell? What kind of product do you sell? What is the current competition, trends? What is market demand? And what can you charge? The bottom price, the break-even price, the high price, and everything in between. So research your competition. Make sure you know your numbers, meaning cost of goods, cost of sales, so that you can price your product accordingly so that you can move inventory and place more orders.